Hey, everybody. Hey, welcome. Hello there. Hey, I remember you from the other session. There you go.
How are you?
It's great to see you. It's great to see everybody here. Come on in. We're going to go ahead and have some fun today with Financial Essentials, Section 1. And this is going to be great. We got some friends coming in, some more friends. It's going to be great. Come on in. We've got Cindy, Danielle, we got Brian, Dustin, Candace, Kim, Kelly, and many, many more that are here. We have a couple of our advisors that are here to help answer questions. And this is going to be great. So we have a lot to cover today. Hour and 15 minutes plus extra time for your questions. And so that's going to be awesome. All right. Hey, good morning. Good morning. It's great to see our advisors here to help answer any questions that we have. And we're going to get started because it is the top of the hour. It is 9 o'clock. All right. My name is Dr. Arnaud Prévost. I'm a program coordinator here with the Small Business Development Center at BMCC. We have a couple of advisors here, but I wanted to start off. Oops. Here we go. Here is our group, just letting other people in here. This is great. This is awesome. All right, so more people coming in. This is who we are. We are the SBDC at Blue Mountain Community College, helping you if you have any questions at every level of the business development process, from business ideation to business growth and so on. Here we are. Give us a call or write down our number if you have any questions, if you wish to speak to our business advisors, 541-278-5833. At the end of our session, I will go ahead and give you that number again. SBDC at bluecc.edu, SBDC at bluecc.edu. And today is our Financial Essentials and Creating Business Reports, Financial Reports section. This is what we're going to do today. This is only part one, everybody. We have part two, which is going to be next week, where we're going to take a look at QuickBooks, and we're going to take a look at growth and funding. So once again, if you have any questions, please make sure. Don says good morning. Stephanie says in the chat, good morning, everyone. Happy to be here. We're happy that you're here, Stephanie. I'm an early stage business, 2023, sells upcycle stuffed animals and personal accessories. Welcome. So let's keep going. Today, we're going to tackle. I'm having some audio.
John, can I go back to you? Nice.
I'm having some technical issues here. And audio is playing in my ear. Just give me 1 second here. I don't know if you guys can hear that, but that's fine. Let's go back to our screen here, everybody, and so that we can begin. Please make sure to remember that if you have any questions, put them in the chat, and make sure to mute your audio so that we don't get any background or audio or anything like that. So let's begin. So here's what we're going to do today. We're going to review the 7 steps to maximize the value of your business from Profit Mastery. We're going to take a look at a number of different things, including most essential financial statements, and we're going to discuss what's on them. We're going to take a look at how money flows through a business, distinguish profit from cash flow, and then determine the most important ratios and what they tell about your business. Very, very important. We have another friend coming in here. Very good. Very, very important. And we're also going to take a look at how to calculate the break even for your business. So these are financial essentials. Looking at the Profit Mastery section here, what are the 7 steps to maximize value for your business? Well, one of the important things that you're going to have to do is plan properly, right? As you know, businesses don't just come out of thin air. You're going to need to monitor your financial position, understand price, volume, cost, and you're going to also know how to manage your cash flow. We're going to go ahead and manage growth and borrow properly. At the same time, we're going to take a look at how to plan for a transition. These are the different steps that you're going to have to take a look at if you want to maximize your value for your business. Oops, we got more chat here. All right. Now we're going to take a look at a quick little quiz here. You don't have to answer these quizzes, but these answers, but the more sales I make, the more profit I get. Is that true or false? Think of it in your head. Well, guess what? It's false because now you can answer it in the chat if you want, but like I said, I could give you the answer already. The answer is false. The more sales I make, the more profit I get. Well, the answer is false because it's important not to underestimate how much it costs to make a sale. Fundamentally, all right? Let's take a look at the next one, all right? The next question, 50% of all businesses fail within 7 years. What do you think? Well, the answer to that is actually kind of surprising because 50% is not the number. 80% of businesses fail within the first 7 years. And that's really, really interesting and really, really important, all right, that we understand that. Now, how about this one? Net worth is equal to the assets minus the liabilities. Read it again. Make sure that you got it. Is it true or false? You can say it in your head or in the chat. Net worth is equal to is equal to assets minus liabilities. The answer is true. All right. All right. For example, this formula right here is going to be a foundational formula when we take a look at our business, our financial statements. Okay, net worth is equal to assets minus liabilities. All right. The best person to keep track of the finances of my business is the one who's best at math. What do you think? True or false? Well, this is a very common question that we get, and the answer is false. Don't be intimidated by the words accounting or finance, right? You have to be able to add, subtract, multiply, and divide, and that's it in order to really take a look at financial essentials for your business. It's not the most mathy person who is going to take a look at all the numbers here. It can be, but there you go. So numbers, financial statements, financial information, right? They tell us a little bit about history and about the unknown. Why is this important? Well, because when we take a look at history, right, it teaches us something about the past. We can take a look at it from an accounting point of view. It tells us what happens, and we're able to document and record. That's very, very important, but also it helps us plan for the future, the numbers, right? Future, if you're controlling or projecting, all right, or it could take a look, you could take a look at a number of assumptions. It helps you with the what ifs, so to speak. So that's important. But it's not just history of the past and then the unknown of the future. It also helps us take a look and understand the numbers at what's happening in the present. Questions with regards to finance, questions with regards to what's happening currently right now, any actions or impact that we need to take, and to be proficient in the numbers is very important. So these two slides really showed us the importance of taking a look at the numbers, right? When it comes to your business, the past, the future, but also the present, the now, so to speak. So that's important as well. All right, let's take a look at the accounting cycle. And it's the process of recording what has taken place and ensuring that the numbers actually balance. Everybody who has a business or anybody who has a personal checkbook or anything like that knows the importance of balancing it, right? We start with classifying accounting transactions, right? Something has occurred. We start with that, all right? Very good. And then we record it in the ledger, in the general ledger, making sure that it is recorded in one capacity or another through a program like QuickBooks or even through a spreadsheet like Microsoft Excel. It doesn't have to be anything fancy. All right. Also, we have, we are posting in the general ledger, making sure that there aren't any adjustments. We adjust the entries, and then we can, from that, generate financial reports. The information is only as good as the information that you put in. So that's very, very important. And following that accounting cycle is key, is going to be key. Okay, great. Oops. There we go. So why in the world should I care about the numbers, right? This is a good question. It seems like a very simple question, but it's a very good question to look at. All right, let's take a look. I'm going to care about the numbers because I want to better understand how hard I'm working for the money I'm making. That's important. All right, to be presentable to a lender, if you wish to go to the bank, they're going to want to see the statements that and the numbers. Absolutely. To make tax reporting easier, but also more accurate. To compare your business with other businesses and to show creditworthiness to maybe a bank, a credit card company, or an investor. These are all reasons why I should make sure that I understand basic financial essentials in my business and that I know how to produce these financial documents, which we will take a look at. But also, to have some idea of the profitability of your business, this is also important if I ever want to sell it. It's not going to be a guess, a wild guess. Oh, I think my business is worth this or that. No, no, no. With the numbers, you're going to have the hard facts and that you're going to be able to present to a prospective buyer if that ever comes to it. All right. So the SPDC is often given, the advisors are often given information with regards to accounting from accountants, information they want to pass on to small business owners. And these are the 5 tips that we have collected for you, small business owners or prospective small business owners. And let's take a look. So top tips from accountants to small business owners. Here we go. Number 1, keep your business and your personal finances separate. Very important, very, very important. All right. You don't want to commingle anything like that. In some cases, it's when you're filing documents, if you make a mistake, that could be a legal thing. So you have to be very careful about that. You want to make sure that they're separate. All right. Also, keep track of all your expenses along with receipts, documentation, and along with proof. That's key because at the end of the day, you want to make sure that you have the proof. You want to make sure that you have the receipts that are there. And this is key. This is very important. All right. Balance the bank account every month. All right. Make sure that you're not forgetting that and go, oh, I'll do it at the end of the fiscal quarter or something like that. No, no, no. Balance it every month. This is another tip from accountants to small business owners. All right. Next, use an accounting or record-keeping method or program to categorize and record your transactions. Again, it can be as simple as a spreadsheet if you know how to use a spreadsheet, or more complex programs that actually can help you a lot, like QuickBooks. We'll talk about QuickBooks next week. Okay. All right. Now, don't wait until the last minute to file your taxes. That's number 5. Very key, very important. We have it all here. This is great. All right, so we're going to talk today about the 3 financial reports: the balance sheet, the income statement. Let me see, where's my little check here? The balance sheet, check, the income statement, and then the statement of cash flow. They are 3 separate reports, and they allow you to see business information and intelligence that you would not otherwise be able to see through the use of ratios, Oops, here we go. So a balance sheet is a statement of assets and future benefits and claims on them. The important part that you understand about the balance sheet is that it's a snapshot in time. It doesn't give you any more than a specific snapshot in time. You produce through these programs like QuickBooks a balance sheet today, and in a month from now, you're going to have 2 different balance sheets because more activities will have occurred in between that month, that period. All right. And it uses fundamentally the equation, like we saw a little bit earlier: assets equals liabilities plus owner's equity. Assets equals liabilities plus owner equity. All right, we have more friends coming in. That's great. Awesome. Awesome. All right. So there you go. Oops. Now, what does a balance sheet do? A balance sheet does a number of things. Oops, click the wrong button there. It happens all the time, including a balance sheet shows you what you own and what you owe. It identifies what you own free and clear, okay? And what items you're making payments on, for example. Someone's personal balance sheet might include their house, their car, their personal belongings, their savings account as assets. But it also includes lists of any monthly payments due on any of these items as liabilities, okay? So for example, you might still be paying off that house or that car and so on and so forth. Now, the difference between the assets and the liabilities is that financial worth, all right? So that's important, all right? It's the same with a business's balance sheet. All right, it's the same with the business's balance sheet. A restaurant, for example, asset list would include something like equipment, supply, furniture, utensils, aprons, dishes, and so on, right? The liabilities would include things like money owed to the suppliers, payroll, balance due on a credit card or a loan, and so on. Also, a contractor's asset list would include things like a truck or a trailer, any tools that the business owns, or something like that. So that gives you a great idea of the assets, liabilities, and so on. Contractor's liabilities might be money owed on material, payroll, that sort of thing. So a balance sheet will look something like this. Let's take a look at it. It has, oops, let's make sure that I have it has the assets right here, as you can see, right there. This is just simply an example, just an example, right? Assets right here, nice, all right? It has any liabilities right over here, and any owner's equity right over here, any equity or retained earnings right there. And you notice, this is important, that the total assets will equal the total liabilities plus the equity in question, okay? So that's important. That's important to know that it is properly balanced. That's how it will be shown, and so on. Now, let's take a look. Current assets, anytime you see this word current, where am I? I see a couple of questions in the chat. Thank you, thank you. Anytime you see the word current, it means within 1 year. So current assets, current liabilities, okay, are those that are applicable within the year, within 12 months. All right, that's important. Okay, very, very key. All right, let's take a look. So an example of an income statement is, oops. Oops. There you go. So let's get back to this just a second here. Let's see. So an income statement will look a little bit different. Okay. For example, we have revenues and expenses. And so this just gives you a different approach here. And we'll talk about income statements in just a little bit. But again, to compare both of them, all right, we have the revenues here, so the particulars, and the expenses, all right? So that's a little bit different, also known as a profit and loss, and we'll get to that in just a little bit. All right, just wanted to show you the differences between them. Just you have revenues and then you have expenses. We'll talk about this in just a little bit. We have another quiz here, okay? Very, very important. You don't have to answer in the chat if you don't want to, that's all right. But the cost of goods sold is the cost of making the product. False, be careful now. The cost of goods sold is the total cost incurred for making a sale. You'll hear this in accounting a lot, cost of goods sold, or COGS, C-O-G-S, all right? That is a term that we will hear. And so just so you know that it is the total cost of incurs making a sale. So for example, production, shipment, labor, overhead, and so on, okay? So that's going to be important to note, okay? Also, accountants advise small business owners to balance their accounts, their business account, on a monthly basis. Do you remember that part? Aha! Do you remember it when we looked at it? The answer is yes. Mistakes are always easier to find when discovered soon after they happen, all right? That's important. An income statement shows how expenses affect cash flow during a specific period of time. And again, we'll talk about this a little bit more when we talk about income statements, but an income statement reflects the revenue and expenses, all right? That's the difference, all right, between a balance sheet and an income statement during a specific time, but, and this is key, does not demonstrate how the cash was used. You're going to need you're going to need a statement of cash flow for that, all right? And let's talk about a statement of cash flow, a report of actual dollars coming in and coming out, all right? And it measures the ability to be financially effective, particularly in the short run. That is the other one. So we have balance sheet. We're going to take a look at income statements in just a little bit. Now we have statement of cash flow, all right? What does it look like? What does it mean to have the amount of dollars coming in and coming out, right? So again, it shows how cash was used in a business, okay? And it's typically broken down, statements of cash flow are typically broken down into operations, investing, and financing. So the amount of the cash going in and out for operations, the cash going in and out for investing, and the cash going in and out for financing, all right? So what is operations, investing, and financing, right? So again, the operations, I'm sorry, I went a little fast on this one. Operations shows you the day-to-day money that goes in. Investing, if you have made a large investment or a small investment, money that can come in and come out of that. And if you're financing anything, for example, if you're financing things like, if you're financing a truck, for example, equipment or anything like that, money that comes into it, money that comes out. So this is important as part of a statement of cash flow. Oops. Statement of cash flows also, again, shows where the money comes from and where it is going. Purchasing more inventory increases your total assets, yes, but you need to pay for that inventory. Don't forget that, okay? So that is an important thing. It shows where the flow is going. So that's key. That's really important. A cash flow statement shows how your available cash is being used to create an increase on your inventory. Now, again, please be careful. Buying in new inventory is an expense, okay, as we all know in business, okay? So it's shown as a decrease or an outflow of cash. So when we see that, we'll take a look. All right, I want you to remember something here, okay? A primary cause of failure of a successful business is, oops, I clicked on the wrong button again, I apologize, is uncontrolled growth, all right? If you do not have the money, if you do not have the cash flow, if there's not enough cash on hand, you can get into a serious problem, even if your business is growing. And so that can be a cause of failure for a successful business. Our company can grow too fast and not be able to handle the amount of cash or the flow of cash that is coming in and coming out. So this is a warning. It often, it seems a little counterintuitive. Well, my business is growing. That's great. I'm selling more. I'm doing all these things. Absolutely. Well, if the cash flow isn't there, if you don't have the amount of cash, right? You know what I'm talking about, then it can be a problem because this can cause your business to have some issues, okay? So yeah, that's important. All right. This is an example of a statement of cash flow, all right? Let me take a look at this. And then I will get to the questions after we're done with cash flow. A number of SBDC advisors have been replying. Thank you very much. That helps me a lot. We have a lot of slides to cover. And so, yeah, absolutely. So take a look at this. Take a look at this. Cash flow from operations. So for example, we have adjustments for depreciation, adjustments for increases in inventory, and so on, adjustments for decreases in the accounts receivable, and so on. So net cash flow from operations, for example, this is important. All right, you get that information from your other sheets, your other the balance sheet and the income statement, which we will talk about in a little bit. But you plug in those numbers, and these numbers are very, very important. You get that from your QuickBooks or or things like that. All right, cash flow from investing. All right, this is the second category. All right. And then cash receipts for sale, for example, cash receipts from sale of property and equipment, cash paid for the purchase of equipment. As you can see, that's in the negative. So cash flow from investing will be in the negative as well here. And then cash flow from financing, maybe your cash paid for loan repayment or something like that. Again, these are the three categories for the statement of cash flow for the different activities that you have. All right. Okay, great, great. Well, this is awesome. All right. Whoops. Before I get to that, let's get to the chat. All right. We have a number of new messages. All right. Let's see. I want to make sure that I have it right here. True or false? Yes, very good. Very good. True or false? I'm sorry. Will we be receiving CE credits for CCB licenses for this workshop? I don't think so. Jeff says, yes, I believe you're right. Okay. More sales, as Christy adds, this is very good. More sales isn't helpful if you're losing money on each sale. Very true. Absolutely. All right. Okay. Those of you in the service business will have a slightly different looking statement since we don't have cost of goods sold per se. Absolutely. That's very true as well. Okay. Thank you very much. Now, let's talk about ratio analysis. Now, that sounds like a big word and a big complicated technical term, but it really isn't. Ratio analysis is an important thing. It focuses on the number from your accounting records. It sets two numbers into a ratio and then tracks the trend. And again, remember this, trends are always more important than individual numbers. Trends are always more important than individual numbers. By plugging in two numbers, you get a ratio. That ratio will give you a lot of information about how your business is doing financially, and that's going to be key. That's going to be key. Okay. And you get that information from your three documents. So numbers tell you what happened in the past, trends, which direction we're headed in the future. Okay. So again, all right, so that's important. So we'll talk about that in just a little bit, how to form ratios in our section 2 today, which is going to be fun. All right, let's talk about the income statement. A statement, also known as a profit and loss or a P&L. This is our third example, or third financial statement. So it's a statement which reports revenue, money earned and received, and expenses, money spent to do the business. It shows the total income and expense over, and this is important, over a period of time, whereby the balance sheet was a snapshot, right? In this case, we're looking at a general period of time, a month, a quarter, a year, and so on. As always, we're looking at revenue minus expenses will give us the profit or the loss in question, which is why this is called a profit and loss statement, okay? All right, this is important. So if you remember one thing about this slide is that the income statement, the profit and loss statement, the P&L is over a range of time, over a period of time. Everybody got it? Got it good? Very important. All right, thumbs up. Awesome. Okay. All right, let's make sure that we got this. Okay. So financial ratio types. Back to ratios. Okay, our slide shows us the ratio. We have a couple of different types of ratio, a few different types of ratios. Remember, the ratios are two numbers that you plug in, okay, that you get from your financial statements. And these two numbers are going to be plugged in and they give you business intelligence, financial information for your business. So we have liquidity ratios, evaluates the business's ability to pay its short-term obligation, also known as current obligations, right? Short-term, current, that's code for within a year. Used by banks to decide whether or not to loan money. Very important. They'll take your documents and they'll make the ratios themselves. Leverage, right? Evaluates how much debt a business has, okay? A comparison of assets to debts. Or efficiency, analyzes how much a business spends to make a dollar, all right? And it's used, and this is important, used to make to judge the management of a business, okay? Very key, very important, all right? So we also have operating we also have operating ratios, and these are key. These are very important because these operating ratios compare expenses as a percent of revenue. Banks prefer this number to be low, all right, because it suggests that expenses are a small cost of making a sale. We're going to take a look at all of these. Profitability ratios also are also there. It means the capacity to make a profit, right? It determines the bottom line for managers and return on equity for investors. These are all the different types of ratios. Four most common ones are debt to equity ratio. In other words, debt divided by equity. We'll talk about that in just a bit. The current ratio, return on equity, net profit margin. So a debt to equity ratio, our very first one. I went a little fast here, I apologize, but we're looking at all the ones in question. It takes the numbers from the financial documents and takes the total liability and divides it by the shareholders' equity. So for example, we have $50,000. We divide it by $120,000, which gives us 0.42. In other words, for every dollar in equity, the company has 42 cents in debt. 42 cents in debt. All right. This is key. And remember, it's the most important measure of leverage. All right. Just to make sure that we don't have that much debt. Okay. Debt to equity ratio. This is important. All right. Debt to equity ratio. All right. If you have it less than 1, that's ideal. Whoops. Went too fast. Sorry. I go too fast. I click sometimes. Oh my goodness. It's all good. It's all good. Debt to equity ratio of less than 1 is ideal. Bankers consider a debt to equity ratio of 2 to be risky. Yes, of course. Too much debt for every dollar that you bring in. Okay. So that's key. That's important to know. Where do we get these information, these numbers? We get them from our financial documents, the 3 financial documents. Okay. Current ratio, again, remember, current always means within a year, okay? All right, so can you liquidate your current assets to cover the current liabilities within a year, right? So Charlie's contracting business, for example, has current assets divided by current liabilities, which gives us the current ratio of 25,000 divided by 100,000 gives us 0.25. Charlie has enough current assets to pay off 25% of his current liabilities. He is highly leveraged in this case and would be deemed risky. Banks prefer, sorry about that. Banks prefer a current ratio of 1 to 2 so that the current liabilities would be able to be covered by the current assets. Again, remember, it's always within the year. So these are, that's the current ratio, okay? Current ratio, again, the higher the ratio, the better. All right, an example, if your ratio is 4, this means that the company has 4 times more current assets than it has current liabilities. All right. Let's take a look at return on equity. Okay, return on equity. It's the amount of net income returned as a percentage of shareholders' equity. All right. It estimates the profitability of a business by showing the amount of a profit generated with the money invested by its owners. So the return on equity, this number 3 here that we're looking at, this third one, is the net income divided by the shareholders' equity. Okay. All right. So that's the information that we have right here. It gives us another example of a very useful ratio that we can use. All right. Again, all you need to do is divide. No fancy mathematics or anything like that. It's very straightforward, very simple. We just have to know where to find these. And again, they're in your in your financial documents. It is similar to putting cash into an investment, all right. So a person will want to know how their money is, what their money is making for them as an investment. So that's key. In other words, Charlie, for example, will want to evaluate the success of an investment by knowing how hard his money works for him. And that's key. The higher the return, the more profitable the business. All right. Let's take a look at the last ratio, the net profit margin. And again, it measures efficiency to control costs. All right. It is net profit divided by net sales. A higher net profit shows a more efficiency of the company at converting its income into actual profits. right? Again, this is important. This ratio is a good way of making comparison between companies within the same industry. And it is calculated as follows: net profit divided by net sales. Net profit divided by net sales. Okay, so for example, all right, $15,000, let's say, divided by $45,000, which is net sales, gives us 0.33. In other words, 33% of every dollar of revenue turns into profit. And that's key, that's important right there, as we have the profit divided by the sales. All right, everybody got it? 33 cents of profit is generated by every dollar of revenue earned. All right, great. Net profit margin, again, imagine a restaurant where the sales are increasing, but the cost of ingredients is also increasing. That's tricky, okay? This could cause a shrinking of net profit margins, even though the sales are increasing. And you would know this thanks to that ratio that we just calculated, okay? Let's take a look at the break-even analysis, another very important equation that we have here, okay? Break-even analysis. How much do I have to produce in order to break even? This is a great question, all right? What's the price I need to charge in order to break even, all right? And so the equation is going to be as follows. Everybody see down here, all right? The equation is as follows. Total fixed cost divided by total sales minus total variable cost over total sales. This is a tool that is helping decision makers, but it does not look into the future. This is important, okay? So let's take a look at an example, okay? So for example, right here, I have a break-even analysis, break-even, right? Total fixed cost, all right? I have the equation here, just as we have it over here. I'm sorry, we have a hands up. Christy, go ahead.
I don't know. Can you go over fixed cost versus variable cost real quick?
Yes, absolutely. Absolutely. Thank you. See, this is why we work as a team. Hey, you know, every now and then I'll forget something. So fixed costs are things that are fixed. They are fixed. They are forever, right? So for example, your rent, you know, no matter how much you produce, you're going to have to pay yourself, insurance, you know, for yourself and whatnot. Those are fixed costs. No matter what you produce, they've got to be paid, right? So for example, think of your home, right? Think of your home. You got to pay the rent. You got to pay this, no matter how many people are living in your home, right? And so on. Now, on the other hand, variable costs depend on how much you actually produce, right? You might have increased production and it will cost you more to produce, and that is variable cost. You might have, for example, your electricity bill, right? That might be a variable cost if you use a lot of electricity in order to produce something, right? So that's important. So fixed costs that are fixed forever, right? Forever, quote unquote, right? Forever. All right. No matter how much you produce, variable costs will depend on how much you actually produce, right? So for example, you might use a lot of water in a restaurant in order to wash more dishes because you have had more customers and clients. That water usage, well, that will be a variable cost, right, for you. Whereas the fixed cost will be the building itself, right? For example, okay. So there you go. Let me finish a break even and then I'll get to the questions. A big thank you to Christy and Jeff and everybody else, all the other advisors who are on the call, answering questions in the chat. That helps me a lot. We have a lot to cover. I want to make sure that we get to that. So break-even analysis. Here we go. We have an example. Here we go, right over here. So here is an example of a number. So fixed costs, $66,666, right there. Total sales, $150,000, right? Total variable cost, $60,000, all right, in this case. And then total sales, again, right over here, $150,000. So this is a pretty straightforward equation, and it gives us $111,110. In other words, in this case, right, the break-even point was when we reached an average of $111,110 per month. And we get that information, this is important, again, we get that information all from the all from the financial documents. All right. So let's take a look at one more step. All right, one more step. Okay, and then I'll get to the questions and then and all of that. And again, please feel free to take a look at the chat. Our SBDC advisors are answering questions as we go. All right, very good, very good. An example: average dollar amount per guest spent, for example, is $45. Break-even point: $111,110 average sales. The break-even point per guest is going to be, all right, right here, or 83 guests per day in order to break even. All right, so that is an application of the break-even analysis. Okay, 2,469 guests or 83 guests per day. Let's say it's a restaurant or something like that in order to break even. Okay, very good. All right, we're now in section 2, and I'm going to get to the questions. There you go. All right. All right. Thank you. Thank you. Thank you. All right. So here we go. Yes, indeed, this is being recorded. This is being recorded. Absolutely, there's a question as to whether or not this is, yes, it is. I'm recording on. Okay, good. I got scared there. I was supposed to record. Yeah. All right, balance sheets. Christy says, and this is important, balance sheet shows the big picture. Yes, it does. P&L shows the general health of the business. Cash flow shows short-term activity. Okay, very, very key, very, very important. When we liquidate, we sell. That's right. All right. Diesel, mile taxes are considered variable costs. Yes, absolutely. Yes. Employee salaries, okay, or hourly wages would be fixed cost, right? A fixed salary would be a fixed cost versus an hourly wage. Very true. Very good. All right. Great. All right. Now let's take a look at section 2. Section 2. In this section, we're going to take a look at the most essential financial statements again. We're going to review them. We're going to go ahead and interpret what they say about your business and the business, and we're going to meet a business owner. And Lee has a restaurant. This is a fictitious business owner, of course, but we're going to help her use the financial reports to make decisions. We're going to review some important ratios and so on. But before we do, I'd like to talk about a couple of tools that you can use in order to make your financial documents. You don't have to use these. You can use QuickBooks, like we're going to take a look at next week, but Microsoft Excel, Apple Numbers, or Google Sheets are key. Least to most powerful, so Google Sheets, least complex to most complex. Again, it all depends on your comfort zone and how you're able to use them and so on, right? But they're there for you. All right, let's take a look at Google Sheets, for example. Log into Google, click on those 9 little dots right over here, okay? And it's going to be right over here, Google Sheets. Again, for those of you who are wondering where we are, we're just taking a look at a couple tools that you can use in order to make your financial statements. You don't have to use QuickBooks. You can use spreadsheets. There are 3 of them: Apple Numbers, Microsoft Excel, and Google Sheets. We're taking a look at Google Sheets right now. How to get to it. You don't have to get to it right now, but it is there. If you have a Google account, you can go ahead and type sheets.google.com or click on the Google Sheets icon right over here, okay? Click on a blank document right over here in order to start your spreadsheet. All right, and there you go. Looks like a beautiful blank spreadsheet to me. Absolutely. It's going to be all there. And this is where you plug in your numbers and you can do all of that. Apple Numbers will look very similar, okay, when you start it off. All right, it'll look like this. Whoops. Okay, brand new. So you have a couple of functions over here on the left, and then you have your spreadsheet right here where you can plug it in. And Microsoft Excel also will look similar. It has additional functions. It can be a little bit more, it can be a little less user-friendly at times, but it all depends on how comfortable you are. Again, you don't need to use spreadsheets. You can use a program like QuickBooks to help you in order to go ahead and make these financial documents, but it's all there. It's all there. Okay, it's all there. All right, let's meet Lee. Lee is a restaurateur. owns a small restaurant with 12 tables, seating up to 40 people, and has, you guessed it, 8 employees, one of which is a cook. Lee has been in business for 3 years and is looking to expand to double the amount of seating. Okay, all right. Why is this important? Well, because this is our case study. Okay, why should Lee care about the numbers? Well, we saw this about 30 minutes ago, why you should care about the numbers. But let's remember, it'll allow Lee to better understand how hard she is working for the money she's making, allows her to be more presentable to a lender, allows her tax reporting to be easier and more accurate. All right, and it allows her to compare her business with similar businesses, and it'll show her credit worthiness to a bank or an investor or credit card company. And to have some idea as to the profitability of the business if Lee, in this case, if she decides to sell. All right, again, these financial statements will help Lee make decisions because Lee will better understand where she is financially and the direction of the business, where the business is heading. Lee will have information to share with others, such as a bank or prospective investors. Okay, Lee can decide if this is a good time to expand by looking at the debt that she has now and the trend of sales over the last couple of years, right? Last few years. Again, the 3 financial statements that Lee can produce includes the balance sheet, the income statement, and the statement of cash flow, which is very, very key. Okay, and we're going to go ahead and take a look. Again, it is a snapshot in time. I don't want to, this is a review. I don't want to go ahead and spend too much time on that. Again, balance sheet is a snapshot in time, right? All right. What does the balance sheet do? It shows your assets, okay, and your liabilities, all right? Lee's assets, for example, in our case study can include petty cash, cash in the bank, accounts receivable, equipment, furniture, food ingredients, drink ingredients, supplies, and whatnot. Lee's liabilities include her accounts payable, maybe sales tax, income tax, short-term loan, and a credit card balance, okay? All right, so let's take a look at her balance sheet. This is it, this is the big one, okay? Take a look, all right? Everything has been put in, all of the information is there. Again, the current assets and liabilities are those that are due or used within 1 year. And the owner's equity, sorry, is the difference between the total assets and the total liabilities. In other words, the total amount of assets that is owed, right, debt-free by the owner. So we have numbers here that are plugged in, all right? And we have the total assets, total liabilities. This is our balance sheet, a snapshot in time, okay? And we have the owner's equity right here. You can see it all, food ingredients, for example, drink ingredients, all the money that Lee has in the business at this specific snapshot in time. All right, right over here. That's key. That's important. All right. All right, on Google Sheets, I can do this by plugging in the numbers right over here. All right, on the left-hand side showing assets, in the middle showing liabilities, and on the right showing the equity. I can go ahead and add this up by using the formula sum or equal sum and then open parentheses. For those of you who are unfamiliar with this, make sure you can take this down. This is important. It's all important, I guess, but this is the formula that you can use on computer spreadsheets in order to go ahead and do the sum. As soon as you have the sum, then you can select all these cells from, in this case, B2 all the way up to B9, as you can see down here, and then it'll give you the total sum right over here. You can do the same here with liabilities and equity, okay, owner's equity, okay. Same thing, sum, open parentheses, and then select the cells that you have here. All right, I'm gonna finish off this section and then we'll take a look at your questions in the chat. Same thing here. Again, it's just going from owner's equity. Total equity. All right, here we have assets, just this cell, plus the liabilities over here. And then we got it, and it gives us the total amount. Sum, open parentheses, cell B11, which is right here, plus E11, which is right here, gives us this information here. All right, which is nice. It's key. It's really important. Let's finish off this section before I take a look at the chat. How do we get these number settings? Just very quickly, in the format section right over here, I have number. Click on numbers, and again, this is Google Sheets. Microsoft Excel and Apple numbers will be a little bit different, but they have this function as well. You're going to go to format numbers because that's what you're looking to do, and then you're going to go ahead and go down to financials right over here, so that it can create, for example, parentheses for negative numbers and so on. All right, so again, what does this balance sheet tell us about Lee's business? Lee's business tells us, whoops, we're going to take a look at some ratios, but before we do, back to the chat. Okay, very, very important. All right, thank you, Christy, who's been answering all these questions. Oh my goodness. Very, very important. Let's see. So a question from Stephanie. I've not been paying myself since I'm the owner of the business. However, I know I should. How do I figure out how much I should pay myself? Do I use a percentage? Short answer, meet with an SBDC advisor. Absolutely. It's hard to give, and I'm reading Christy's answer here for everybody. It's hard to give a quick answer without seeing what your business is and how it's doing. But yes, you need to pay yourself, even if it's $20, right? Business owners often subsidize their startup by foregoing income, and that needs to end at some point. Yes, absolutely. Very, very important. All right. Okay. Christy also says, and this is something that I did forget. Thank you, Christy, again. Thank you very much. We work as a team. It's what it is. You don't have to start with a blank slate. No, you don't. Look at accounting templates on the internet. Homeowners equity is that much because in theory, if she closed her business today and sold all of her assets and satisfied her debts, she would get to keep the remaining money, right? This is not considering depreciation. This is true, which is the idea that objects generally lose value over time. Like a piece of furniture might be purchased for $500, right? But a year later might not be worth as much. Let's say you purchase a piece of furniture for $500 with the intention of keeping it for 5 years. At the end of the first year, it'll have a depreciation of 100, and then 100 every year. You can do that, for example, until it gets to 0 because your idea was to use it only for 5 years. So depreciation also is key, to a key number to put in here as well. Very good. Very good. Thank you very much. So let's take a look at a couple of ratios, how we figure out these ratios using Lee's information. All right, so this is Lee's information right over here. We can take a look at the debt to equity ratio. Yes. Again, it measures the amount of debt that a business has as compared to what it owns, right? For example, total liabilities divided by total equity is the debt to equity ratio. How do we find the total liabilities and total equity? We find that on the financial documents, all right? So for example, total liability and total equity will be right here on the financial document on the balance sheet. We're going to take that equity, we're going to take that liability, we're going to plug it in, and we're going to go ahead and have a ratio that will give us some information. All right. So for example, in this case, it was $63,000 divided by 162,500, or what we have here is 0.39, or 39% of each dollar of equity is debt. Okay, and that's key. That's important right there. All right, debt to equity ratio is the information that we were able to get from the balance sheet. Okay. Also, a debt to equity is less than 1 is considered good, right? Again, this is key. As the debt to equity approaches 2, banks consider this to be risky because it means, what does it mean? It means that much of what the business has is being paid for by debt. I want to remind everybody who have questions, please make sure to, if you have questions specifically about your business and so on, don't hesitate to reach out to an SBDC advisor. A number of us are already here, and I'll give out the phone number again at the very end, but we are here to help. If this seems like a lot, and it can be, right, we are here to help, okay? Very key. We also have the current ratio that can be calculated from the financial documents. What's the current ratio? Remember, it's the total assets divided by the total liabilities, all right? And so it's right here, total assets divided by total liabilities, all right? And so this gives us 3.5, 3.5, all right? So Lee has 3.5 times more assets than debt, all right? All right. This is considered good or high for any business because it shows that the debt is low compared to the assets, and therefore a short-term debt could be quickly paid off, right? Again, anytime you hear current, think of within a year, okay? That's the key, all right? Again, creditors like to see the ratio between 1 and 2, all right? So Lee's business is considered liquid and is financially solvent in the short run, and that's important. All right, let's take a look at that profit and loss statement. Let's take a look at Lee's profit and loss statement. Again, it is a total income. It shows total income and expenses over a period of time, month, quarter, year, and so on. The general equation for the second document here is revenue minus expenses equals profit or loss. So let's take a look at Lee's information, okay? All right, so income statement for Lee's restaurant, all right? Profit and loss ending on December 31st, all right? Here we have all the costs. Here are all the costs, right? So rent, lease, debt payments, payroll, taxes, food costs, which is going to be big, it's a restaurant, utilities. We have $115,000, all right? Don't forget that fixed cost, and this is the section where we talk about it, but let's review because we've already talked about fixed costs and variable costs. Fixed costs are the costs that a business pays no matter how the business is doing, right? And this is important, okay? Examples of fixed costs include, rent and lease and debt and things like that. Variable costs are costs that change according to how the business is doing. All right. So, for example, variable costs include, in her case, cost of food and drink, payroll taxes, and utilities, and so on. The more Lee's restaurant sells, the higher the variable costs will be. So those are the differences between variable cost and a fixed cost. All right. So this is key. Now let's take a look at the second part of her P&L, her profit and loss, the income and sales. Food sales are $300,000 in this case, all right? Beverage sales, $100,000. We have catering, events, and gains, any gains from the sale of equipment. This gives us a total of $447,000 of income and sales, all right? Now, keep in mind a couple of things here, right? Revenue equals sales or income from food and beverages in any way that these sales were made, right? Here we see food, beverage, catering, and events. Okay, this is key. The sale and purchase of equipment is to be listed on the income statement, but not as part of the general business sales and revenue, because it's a one-time deal. You understand? It's a one-time deal. If you're selling a piece of equipment, you're not going to have unlimited equipment to sell to go ahead and buttress any financial situation that you have. She doesn't have an oven to sell, for example, every month, right? And that's key. That's key. So, for example, Lee sold a piece of equipment this year, so the amount is received is shown, but it's separate from food sales. And that's all I'm saying, okay? All right. Now, note how Lee can see the sales coming, right, from various ways that she provides services to her customers. It's important to know how it's important to know where the money is coming from, all right, and know what you do and how much money it makes or costs to help prioritize what you do. So, for example, all right, this information is very, very important because Lee makes $40,000 from efforts beyond the sales of the restaurant. So, for example, catering and events, all right? So we see that catering and events right here is $40,000. So that might indicate that there needs to be a change in priority. It's totally up to Lee, all right? And she would talk with the business advisor as well to talk about all of these things, but I'm just showing you a couple of information that the income statement can show you, all right? So the profit and loss statement, the total cost is $115,000, total sales $447,000, the total profit $332,000 for that specific window in time. How do I do that on Google Sheets? Well, the same way that I did it last time. Okay, I go ahead and plug in all of the numbers. All right, I add the formula right over here, sum equals sum, open parenthesis, and then select the cells right there. I do the same at the bottom, equals sum, open parenthesis, nice. And then I do the same thing here where I add these up. I will add this negative number with this positive number, right? The total cost, total sale, and that gives me the total profit and loss right over here, $332,000. So Lee's income statement will look like this overall. So we took a look at the two sections, and there you go. So this is, again, if you're lost, I don't want you to be lost. We are on our case study with Lee. All right. So what does this statement tell us about Lee's business? Well, we go back to ratios here. Let's take a look at return on equity. Return on equity is the measure of efficiency and tells us how much a business spends to make $1. All right. And it's calculated by doing the net income divided by the owner's equity. Okay, so net income will be down here. Okay, owner's equity is back on the balance sheet right here. Okay, so again, that's how we do it. All right, that gives us a return on equity of 2. So Lee's equity in the business is business generated sales of 2 times her equity. Right. All right, we know this is high or low only by comparing it to the average return on equity from other businesses in the same industry. All right, banks will use this as well. Also, Lee will need to be careful and not to look at this or any other ratio in isolation, but to take a look at the full picture, to get many ratios to get the full picture. Don't get confused or overly enthusiastic or pessimistic if, for example, you have one ratio that gives you a great number or a too low of a number. You're going to have to take a look at all the ratios together, right? It's part of a trend. It doesn't necessarily show you everything in isolation. This is important, okay? The average ROE, or return on equity, will vary depending on the industry, okay? So Lee can boast about her return on her investment and feel confident that her restaurant, in this case, was profitable in 2020. However, what matters most is how the business has done over the last 3 to 5 years. Again, these are all trends that we're looking at, not just 1 year. All right, comparing the numbers over time shows the direction that the business is heading. Also note something important. Consider the idea of seasonality. These 3 statements, the statement of cash flow, the balance sheet, and the income statement, all right, will give you information. But it could also provide, if you run these numbers monthly, for example, it can also give you an example of seasonality. Outdoor focused businesses, for example, might do better during the spring and the summer and the early fall than they would in the winter, and so on. So again, these are things to look at as well. Trends. Also, we can take a look at the net profit margin. Whoops, went a little fast there. Net profit margin tells us what percent of each dollar is turned into a profit, right? So for example, net profit or divided by net sales, right? Net profit or loss divided by total sales. So where are we? We're right here, 332 divided by total sales, 447. In this case, we get 74% of every dollar is turned into profit, which is excellent. The higher, the better, okay? So these these ratios help you find the trends, all right? Net sales is also the same as total revenue. It tells us, all right, it tells what the amount of money earned by the business was during the period without considering the expense. Net profit is what is left over after all the costs are considered, all right? Let's take a look at a quick quiz. Again, you don't have to answer it in the chat. Just it's there for you. Just a little fun little quiz. All right. Total revenue is shown on the balance sheet. Do you remember? You might have to go back and take a look. There's a lot of information that we've gone through so far. Total revenue or sales is reported on the income statement, also known as the profit and loss. So total revenue. All right. Accountants advise small business owners to balance their business account on a monthly basis. Yes. Again, you're going to find mistakes faster when you do this monthly. All right. Very important. The measure of profitability is the current ratio. False. The current ratio is the measure of liquidity. Remember, current always means within a year. So the measure of liquidity, how fast you can liquidate something, how fast you can pay off, right, your debts with your current assets. Okay, that's important. All right. Current assets divided by current liabilities will give you the current ratio. That's the current ratio right there. All right, let's take a look at our friend Lee's statement of cash flow. All right, statement of cash flow, remember, shows us how money was used in a business. It's broken down into operating, investing, and financing. In this case, this is the statement of cash flow for Lee's restaurant. I'm looking at the time. I have 10 minutes left. Oh my goodness. It's okay. It's all right. I'll cover everything. It's all good. Statement of cash flow, again, from three things: operating cash flow, investing cash flows, financing cash flows. We have the information right over here. Okay. Total, in this case, I'm sorry, cash ending balance, $400,000. Net cash changes, 336,000. Okay, we plugged in all these numbers. All right, and again, this is the cash coming in and coming out. All right, again, how do I do this on Google Sheets? I go ahead and do this in the same way that I've done it before, by using that sum, and it's all there, all of the information. Okay, net cash changes, and it's right here. So I've created the statement of cash flow for Lee's restaurant. What does this tell us about Lee's business? This tells us a lot. All right, selling a piece of equipment or asset brings money into the business, so it is shown as an inflow of cash, and the loss or gain is reported under the operating cash flows. All right, so so it was a loss. All right, it was a loss, so it's shown as a decrease or outflow of cash because the equipment was sold for less than Lee paid for it. All right, Lee's sales exceeded her obligations by $325,000. All right, when considering the sale of an asset. And when considering the sale of an asset, an improvement to the space, and the loss on the sale of an equipment, for example, there was a net change of cash of $336,000. Also, note that the beginning of the cash balance, all right, note the beginning cash balance was the total amount of money paid in accounts at the end of the last statement, right, in the same period before the date of the report, right, which in this case would be December 31st, 2019, right? So you start with the last number, right, that you had, right? The net change in cash shown on the cash flow statement shows the flow of cash through the business through 2020 in this case. Right? It was a strong sales year for Lee, so she has extra cash to invest, pay off debt, or take out as owner's equity. All right, and this is key. All right, the surplus of cash will be favored by a bank, for example, should she decide to apply for financing for her expansion. This is unless this year was particularly stellar year as compared to the 3 to 5 years, right, when there were losses or small profits. Again, Lee's situation is very important because if she had a stellar year, but the last 5 years showed that there were losses or small profits, banks will look at that and go, this was an unusual situation, right? Look at the trends. Look at the 3 to 5 years. Much more important than simply looking at 1 year. All right. Before I take questions in the chat, and thank you again for our advisors helping out with the answering of the questions. There are probably things that I'm missing or going over, but that's okay. We're all in this as a team. How much does Lee have to sell to break even? How many customers does Lee have to serve in order to break even? We go back to the break-even analysis formula that we had a little bit ago, all right, which is fixed costs divided by total sales minus variable cost divided by that total sales. And again, it is a tool to help decision makers. We have, and we get these numbers from, and this is key, from the statement of cash flow, income statement, and balance sheet, very important. We have a break-even point where Lee reaches an average of $21,250 of sales in every month. Above the average is profit, okay? And that's key. So she needs to make that $21,250 a month. Anything above that, profit. Okay, anything below that will be a loss, right? All right, one more step for Lee. Let's make sure that we know what to do with that break-even analysis, okay? The average dollar amount per guest is $25, great. The break-even point we calculated was $21,250 per month, awesome. The break-even point in guests is 850 guests a month or 28 guests per day in order to break even. So Lee has used, and this is important, Lee has used all of the 3 documents plus the ratios to determine the financial health of her business and how it's going at a snapshot in time, how it's going for the year, maybe how it's going for 3 to 5 years, to determine whether or not she could apply for financing for any expansion for her business. If you remember, that was the point of our case study with Lee. All right, great. And so today we had a chance to take a look at financial essentials, which was awesome, and creating financial reports. Again, that was great. You guys had great questions. I'm going to take questions in just, let me do that now. Let me do that now. All right, we got a question here. As an owner and paying yourself, do you need to specifically register as a, do you need to register as a specific entity? There are a number of options, says Christy, who had to go. Thank you, Christy. Go to the Oregon Secretary of State website or meet with your advisor for help. Some sole proprietors operate under their own social security number. Absolutely true. But I would only consider that for a service-based business. I agree, absolutely. Christy has to jump off. Don says, have a good day, Christy. Thank you very much. We are not done because next week we are tackling QuickBooks and growth and funding. And this is key. This is who we are. I've been Arnaud Prévost, a program coordinator for the SBDC at Blue Mountain Community College. Please give us a call if you have any questions about your specific business. Again, at any step of the business ideation, from business ideation to business development, and so on, growing your business. SBDC at bluecc.edu, SBDC at bluecc.edu, or give us a call at 541-278-5833. 541-278-5833. This is who we are. Our director is Eric Deleri. We have a number of advisors, including Jeff, Dan on the line right now. Christy had to pop off. A big thank you to all of the advisors that were kind enough to help with answering the questions. I will be here until however long anybody has any questions. You guys can go. I will see you next week, 1 week from today. 1 week from today. It's going to be great, 9 o'clock, and we're going to tackle our part 2. So I hope to see you there. So thank you, everybody. Thank you so much. Thank you for your time. It was great. I always love teaching this class. This is awesome. Any questions, please make sure to stay online. You can unmute. We can have a chat. We could have a great chat. It's awesome. So thank you, Dustin, Grace, Nicholas, Kelly, everybody. If I'm not getting your name, thank you. Thank you, Dawn. Yes, you will get access to that. We have a YouTube channel. Just go ahead and go on YouTube, SBDC at Blue Mountain Community College, BMCC, and you'll go ahead and have that. It's all there for you. For the recording after class. There was a lot of information. Next week, it's going to be a little bit less. We'll have some more time to spend on growth and funding, all that jazz. It's going to be awesome. It's going to be awesome. I look forward to seeing everybody there. Thank you very much. Any questions, please let me know. And reach out to the advisors. Reach out to the advisors. There might be specific situations where you might not know. Oh, we got a hand up here. Go ahead and unmute.
All right, good morning.
Hi.
Hey there, my name is Itlali and I have a question. I often have difficulties identifying how can I pay for myself? How
Right.
is that? How can I determine how to pay for myself? How can I determine whether the charge is per hour and how much per hour or how much per month?
Right. So my very first answer will be every situation is unique. And the best thing to do is contact a SBDC advisor about your specific situation. Much like Christy mentioned in the chat, a lot of people start foregoing their own, a lot of small business owners forego their own income for a while, but it eventually has to end and you have to pay yourself. It could be as little as $20 to start with, but eventually that grows, commensurate to the amount of effort that you put into the business, and that's
how
important.
profitable that business is,
And how-
like I said, and on cash flow. So
And on cash flow, yeah, it depends.
So some businesses owners take a lot of money during their peak, like in my situation with the clothing store. Christmas, you take a lot bigger paycheck than you would in February.
Right. There's a seasonality to it too. It depends on your specific business. And again, being able to meet with Christy, Jeff, anyone on the team, any one of the advisors, really they'll look at your very specific numbers and be able to tell you for you, how much that would be, how much that should be. There isn't a magic wand. Again, it depends on the cash flow. Magic number. No, there's, it's very specific. So you don't want to overdo it. You don't want to underdo it. That's key. That's key.
Perfect. One last question.
Yes.
Is there here an advisor that specializes in trucking?
In trucking, that let me ask Jeff. Jeff, do you know if there are any advisors
I don't
specializing in
think any
trucking?
of us specialize in that, but we all have some direct knowledge with it.
Okay.
So where are you located at?
I'm located in Boardman.
In Boardman? Okay,
Mhm.
okay. Yeah, we have advisors in that area. So if have you signed up for our services before?
This is actually the first time attending. No, actually my second time attending
Okay.
a class. So I need more direction on who to contact. I got the phone number for the SBDC.
Mhm.
So I'll be reaching out and start contacting.
Yeah, we're a free and confidential service. So it's a great opportunity for you if you want to get with us and we can go through it.
Awesome. Thank you.
All right.
You
Thank
bet.
you so much. We have a question in the chat. My background is in art. Oh, it's like my wife. My wife's background is in art. It's the same. Oh my goodness. So the business side of running a business is new to me. I feel like today's class was almost a 201 level for me. That's okay. That's all right. That's all right. Do you have a class that simplifies these concepts some more? So you can take a look at a number of resources on YouTube that might simplify these concepts some more. I would recommend that. Just go ahead and go on YouTube and type in income statements or balance sheet or statement of cash flow. That's what I would say for Stephanie, who had that great question. Thank you so much.
And Stephanie, if you need to talk to an advisor, we can sit down with you and explain each of those.
Yes. And that's key. That's important. So thank you, Stephanie. Thank you, everybody. Any other questions? Stephanie says, I met with Cindy and she was very helpful. There you go. Cindy is wonderful. Wonderful. And I'm glad that she was helpful. Very good. Very good. Thank you. All right. I will watch more YouTube videos. Absolutely. And we have our own channel, but we're all, any resources that are out there, that's what we do. We advise, we help at any level of the business development, any level. So if you're new to the business development, if you're new, that's perfectly fine. That's perfectly fine. Anybody else? Any other questions?
How can we get a hold of the slices that you use during the class?
So you'll be able to get a recording that'll show all the slides and all that information. We need to edit this just a little bit, and then it'll be posted on our YouTube channel. Financial Essentials for Small Businesses. Financial Essentials. That's what it's called. There are there are previous year's recordings of the same class with a different instructor that you can go and check out right now as soon as we're done. Same slide presentation. I change it every year. I change it every year, making updates and so on. But for Financial Essentials, it's pretty straightforward, you know. So thank you so much for your questions. That was great. All right, anybody else?
Good job, Arnold.
Oh, well, thank you.
See
I'm
you
gonna
next week.
See you next week, everybody. I'm gonna stop recording.